Hello, I'm David Cassidy with the midweek budget update. Today, Wednesday, the 3rd of March. Well, despite the rumours, Rishi Sunak, the Chancellor of the Exchequer, is keeping with the Conservative 2019 manifesto pledge not to raise the rates of income tax, VAT or national insurance. Despite widespread speculation that various tax allowances would be frozen, the Chancellor announced that planned increases to the personal allowance and the higher rate tax threshold would still take place for the new tax year. They will then be frozen until April 2026. This means that the personal allowance, which is the amount of income you can earn before you start paying tax, will increase to £12,570, and for England, Wales and Northern Ireland, the higher rate tax threshold will increase to £50,270. The personal allowance is the same across the UK, but the Scottish Government sets out its own tax rates and bands, which were announced in its own annual budget. There have been no changes announced to either the dividend tax or the personal savings allowances, so they will remain at £2,000 and £1,000 respectively. Lower allowances, of course, apply to higher and additional rate taxpayers. It was pleasing to see no change to ISAs, which is good news for all savers. The annual subscription limit therefore remains at £20,000 and can mean a couple could shelter up to £40,000 tax-free in a single tax year. Interestingly, Rishi Sunak made no mention of the much speculated alignment of capital gains tax rates with income tax, which could have led to a doubling of the present tax rates. However, it has been announced that the annual exemption for capital gains has been frozen at £12,300 and will remain at this level until April 2026. As widely rumoured and in line with both the CGT and inheritance tax exemptions, the Chancellor has also announced the freezing of the pensions lifetime allowance at its current level of £1,073,100 and again until April 2026. Although this will only impact those who already have a substantial pension pots, the allowance could be closer than some realise, and the tax charges for exceeding the allowance can be penal at up to 55%. Of course, more detail on the announcement can be found in our written budget commentary. Now, from an equity market standpoint, although Rishi Sunak admitted that the thorny issue of the budget deficit and borrowing requirement will need to be addressed, given the UK economy won't fully open until the 21st of June at the earliest, over 15 weeks away, he also admitted that this would predominantly be addressed in the future. Instead, he announced further support for households and businesses to help offset the economic damage caused by the coronavirus lockdowns. For example, he extended the business rates holiday for retail, hospitality and leisure sectors and extended the temporary reduction of VAT for the hospitality sector. This, coupled with yesterday's announcement that the Coronavirus Job Retention Scheme, or furlough scheme, would be extended until the end of September, has resulted in positive share price moves in the high street retailers, JD Sports, Kingfisher, the owner of B&Q, and Marks & Spencer, along with the hotel groups Whitbread and Intercontinental Hotels, and pub chains Wetherspoons, Marston's and Mitchells and Butlers. Likewise, the extension of the stamp duty holiday and the announcement that he was bringing back 95% mortgages to help first-time buyers boosted house builders, including Persimmon, Barratt Developments and Taylor Wimpey. Despite this support, Rishi Sunak reduced this year's expected GDP growth to 4% from the 5.5% he forecasted last November. While this will no doubt be picked up in tonight's TV coverage, it should be noted that the UK's 2020 GDP growth came in much stronger than November's forecast. So overall, at the end of 2021, the UK economy should be roughly the same size as the forecast last November. Additionally, 2022's GDP growth is now seen at 7.3%, up from 6.6% previously. Alongside the budget, Rishi Sunak also published an independent review into the UK's stock market listing rules, and he announced that he will now consult with the Financial Conduct Authority, FCA, with new rules expected to be implemented by the end of this year. This review forms part of an effort to boost the financial services sector post-Brexit, and the review's main proposal could help ignite the market for shell companies, known as SPAC, or Special Purpose Acquisition Companies, as they're commonly called, and this is a booming market in the US. Shell companies are created and listed on the stock market despite having no assets or commercial operations. The sole purpose is to effectively acquire existing private companies, which effectively means that a private company can become a listed company without having to go through the traditional lengthy and costly initial public offering IPO process. Overall, while today's budget statement was much more important and professional than any we have seen for several years, what really matters for UK equities is the success of the coronavirus vaccine rollout and the lifting of lockdown restrictions. And thankfully, that is looking very encouraging. Now, if you have any budget queries at all, please do not hesitate to get in touch with our client services team.